Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you.
Mike, precious metals pulled back. What's the story there?
Well, they have. Since we last spoke, gold has pulled back below $1,800. It was a little bit over $1,900, so it's pulled back over 130 points really in the past 2 weeks. Two things I'd say about it. One, I see this as a short-term move, and I see signs that the pullback is coming to an end. And the main indicator I use to time tops and bottoms in the gold market is the performance of gold stocks, the big cap gold stocks, that is, relative to the metal. When the stocks outperform the price of gold, for instance, Newmont goes up faster than gold goes up, that's a positive sign because that performance of the stocks relative to gold tends to be a leading indicator for both. And when the mining stocks are lagging gold, for instance, when silver went up to like $50 in 2011, the mining stocks stopped going up towards the end of that move completely, and silver went up another $20 or so, and they just sat there. So they were saying this move was going to end, but I can look at this on an hourly chart when we're in a shorter term pullback or move, which we are now, and at this moment the mining stocks are starting to firm up, and they're down today as we're speaking. Gold fell over $20 off the open, but the mining stocks aren't down as much as the metal. We'll see how things end up on the close, but I think the next day that they're up, which could be today, it could be tomorrow, I think it's basically a buying opportunity for people who want to get in at cheaper prices or just simply want to take a position, period. The second thing, though, I think it's worth saying is that while, for people who watch this every single day and what gold is doing, it looks like a big move down has happened, but not really when you go look at, say, a 3-year chart of gold. The low of this year was set in March on the double bottom. Gold fell below 1,700 on that decline, rallied back up to 1,900 by the end of May. So this little decline just puts us in the middle about of the March low and the recent May high. And then we go back to last year, gold made a peak around 2050, and we're basically have been going sideways since then. So that's the real defining trend, is sideways, and we're just at the bottom of that sideways range, or I think establishing a newer high within the range. And it'll take a rally through 1900, and really the next resistance level is 1950 to set the stage for the next really big gold rally. I don't know when that's going to start. It could be after the bottom here and we go right through it, those levels, or it could take even months longer. But regardless, if you want to buy and invest, which is what I advocate, now's the time to do it. And a lot of the small cap mining stocks have barely pulled back at all on this recent drop in gold, which is, a positive sign for them and for the gold mining stock complex in general. And, people can go to, I know, HowStreet.com and find, plenty of companies that y'all cover, that are interesting. So I think now's the time to be buying.
What about other precious metals like palladium and platinum?
Well, they haven't really pulled back as dramatically, I guess, as gold has, but they have pulled back in the past 6 weeks. Just about all precious metals have. Silver has also. Copper when it was at 480 and it fell a little bit below 420. Now it's at 428. Copper mining companies too, like Rio Tinto, it hit 95 in May, and then basically touched $80 and a half or so. Now it's around 85. I'm not really specifically zooming in on the platinum or palladium companies because there really aren't any that are just focused on them only. But today a lot of the silver companies are actually green. Pan American Silver, which is one of the bigger ones that I own, it's up today. But I think one way to look at all this is the gold, silver, the other metals. They all pulled back within what has been a larger pullback or consolidation within the entire commodity index, excluding oil. Oil made a new high just a few days ago, but if you look at the CRB index, it's going sideways. It's not above the high set just a few weeks ago. Agriculture commodities, which actually is something I've got a pretty nice position in, they basically made a double top in May and June. Looks like they put in a bottom last week, and they look like they're just going to go sideways for probably months within some sort of range now. Of the 0.1 out, the price of corn, for example, there's a corn ETF. It hit 23 in May, pulled back to 19, went back up close to 23, went back down to 19, and now it's above 20. It's likely to just continue to go sideways now for quite some time, months probably. And the biggest reason why is because these commodities simply went up so much in the past 8 months. This corn ETF was below $12 in August. It went all the way up to 23. When you see something go up so that much, over 100% almost, basically 90%, in a few months, in 6-8 months or so, typically you then go sideways. You consolidate to prepare the way for the next move. In a certain sense, that's what gold has been doing since the end of last July. Gold was below 1,300 a year ago, rallied all the way up to 2,100, and has been consolidating in a range ever since. And the U.S. stock market isn't really consolidating, I would say, because it made a new high, or it's making a new high as we're speaking. But the S&P 500, the volatility is shrinking in it. We had record volatility in the S&P 500 last year when it declined over 35% and then went up 90% or so from that low from March to Labor Day. That was the fastest drop and subsequent rally ever in the history of the S&P 500. It was extreme price volatility, perhaps the number one defining characteristic of all markets last year. And when you see extreme price volatility, you typically will then have a period of time in which volatility shrinks. And I think that's really what's going on across the board. It's happening with sideways action overall in gold and now other commodities. But when it comes to S&P 500 and the Dow, it's happening in smaller daily price movements, which kind of are putting people to sleep. That could lead to a top later on, but I can't say I see signs of one now. it could just continue to be like this for the rest of the summer.
We'll have more with Mike Swanson right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, crude has been on a tear through the whole year. Do you expect the trend to continue?
Well, historically, crude oil actually makes a short-term peak in July, and then fades a little bit into the fall. Seasonally, that's the historical trend. I would suspect that would probably happen again, particularly in light of the fact that almost every other commodity is now going sideways. So I wouldn't be shocked if the price of oil, which is currently around 73, doesn't dip down to 65 or even 60 by, say, Thanksgiving. That doesn't necessarily mean energy stocks, though, would even pull back that much. But they can certainly enter some sort of trading range of their own. For example, the XLE ETF, which is the biggest energy stock ETF in the United States, it's around 53 right now. It could trade around 53. It could trade in a range of 50 and 57 now. For the rest of the year, or into Labor Day, or something like that. So that wouldn't shock me. But again, this is an ETF that is likely to go into a range at some point and consolidate, because it fell all the way to 21 last March. It went all the way up to 55. So over 100% return in this ETF. In many energy stocks has gone up even more than that. That doesn't mean I think people should sell them if they own them. I own them. I'm not selling. You get nice dividends even when they go sideways in a range. If most energy stocks don't do anything, you still can make 5%, sometimes even more than that.
The cryptocurrencies, is Bitcoin been run down to the ground and has nowhere to go but up?
I'm afraid it's perhaps the opposite. So, Bitcoin was 5,000, fell below 5,000, I think, down to 3 or 4 last March, rallied all the way up to 65,000. But what's interesting is that there is just a manic surge this year, once it got above 30, of individual investors just pouring into it for the very first time. For example, on Robinhood, there's something like 1 million people who owned a cryptocurrency at the end of the year, and by the time 3 months went by and we got to 60,000, that number went up 9 times. Basically, 3/4 of people with Robinhood accounts bought a cryptocurrency in those 90 days during the run from 30 to 60. And now almost all those people have losses. So when you see a market like that, and it's broken down, it's below its 150 and 200-day moving averages, you're in a market that's either a bear market, which is going to be one that has bounces, then another breakdown, and a downtrend that continues until it basically ends, which I think could very well be the case with Bitcoin in these cryptocurrencies, or you have one that's going to go sideways for a very long time. Either way, the upside potential just isn't worth it. If you really think, I'm speaking to the listener, that Bitcoin's going to go to 100,000 or something, well, it's first going to have to go sideways for months. So I would wait wait 6 months and see if it's still above 30. And if it is, okay, make the gamble you want to make. But if it's below 30, you'll know it's a bear market and that you did the right thing by not buying now. I know so many people out there want to hear bullish predictions about Bitcoin, because so many people are in it, they've bought it. Many of these are people that have never bought anything in the financial markets before. It just became a social media mania, and but it's not how it's just what's going on. We had that Bitcoin conference in Miami with I think 12,000 people in attendance, and I don't know if I've ever heard of a investment conference, at least in the past 20 years, that had over 10,000 people at it. So, I've been to an investment conference when there's like no one there in 2008, and that was an incredible buying opportunity. When everyone's at, this is the opposite with Bitcoin. So I tell people to avoid it, and I don't really personally see it as a great investment. It doesn't pay dividends. It doesn't represent cryptocurrencies are really collectible virtual coins. They don't represent ownership in companies. They don't pay dividends. It's like buying stamps, except they're virtual. And I'm not a stamp collector, so I don't want to get into the virtual collectible coin world either.
Mike, is there any other area of investment we should be keeping a close eye on right now?
Well, one other, I guess, important market worth mentioning is the bond market, because we're seeing interest rates actually pull back a little bit in the United States. They've been doing this since March, and the bond ETFs, which trade opposite to interest rates, meaning they go up when interest rates go down, they had a slide in January, February. The TLT ETF, which is the 20-year Treasury bond, made a peak last year of 175 abouts, fell all the way to 132.5 in March, and it's bounced back up 10 points. But I think we saw a secular low in interest rates last year, when they basically went to zero with all the Federal Reserve action. We now have an inflationary environment. Yields ticked up into March, ahead of the record CPI numbers that have come out in the past 3 months. But we're seeing a short-term small decline in Treasury bond yields, which is helping push up the TLT ETF and corporate bond ETFs also. The J&K junk yield ETF is actually trading at a new high for the day, if you can believe it, but it is. However, I think these are short-term moves within the start of a secular rising yield environment. So this is just the start of, I think, a last year, a long-term trend, and we're just having a very short-term move within it. So my expectation is these bond ETFs will get extremely overbought, likely, by the end of July, and make some sort of peak between July and September, and then probably start to go down again before the end of the year. So I think we're in a window, then, in which it might be good to get out of some of these bond ETFs, or in bond funds too, for that matter, and move that money into other things. And I think gold and silver is something for people seriously to look at in that regard.
Mike, thank you so much for chatting with us.
Thank you. Great talking with you.
My guest has been Mike Swanson, editor of Wall Street Window. If you have any questions for Mike, you can contact him through info@howstreet.com, and we'll ask that question for you. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.